Hello and welcome to BloombergQuint. You're watching the fine print. The Goods and Services Tax Council, or the GST Council, has set the rates for services at 18%, which is higher than the current incidence of tax and services, which is at 15%. So come July 1st, in 22 days, will the premiums on your insurance plans cost you more? To answer that, I have with me today on the GST Countdown, Kedar Patki, CFO at IDBI Federal Life Insurance. Kedar, thank you for joining us on the show. Did the 18% rate come as a surprise to the industry, or was it anticipated?
So the finance minister was supposed to set rates at multiple levels, and we were expecting the rate to be either 12 or 18, and we were kind of ready for both. But yeah, so we are here with 18% now.
All right. Help me understand, Kedar, today how does the tax incidence works? Because in various insurance plan, and we'll come to health and your car insurance, etc. in a bit. But on your life insurance plans, whether it's Ulips, whether it's endowment plans, or whether it's term insurance, rather not term insurance, at least Ulips and endowments, there is a risk premium and there is a savings part. Take me plan by plan and help me understand how does the current incidence of tax work?
Yeah, so the way it works is that there are valuation rules, and it's not the insurance premium as such, but every kind of nature of every kind of insurance will have a certain abatement. So while term insurance will attract the full 100% rate, if you talk of endowment, the first year premium, there's a 75% abatement. So that means 25% of the premium is considered to be the taxable value for the purpose of insurance.
So if for endowment plans, I take as an example, if I'm investing or $100 in an endowment plan, I will currently be paying 15% on the $25.
Yeah, I'm paying 15% on the 25 rupees. Going forward, I'll pay
18 rupees.
18% on 25.
18%, right. Okay. And how will it work for term plans? Is there any risk portion at all, or
is term plans are pure risk products, and so there it is 100% of the insurance premium is considered to be value. So 18 rupees on 100 rupee premium will be the tax.
Okay, endowment plans, I think like you mentioned that the rate of tax will change year from year. How will that work out?
Yeah, so for the first year, the abatement is 75%. That means I pay tax on 25% of the premium that I have paid for the first year. Second year onwards, it is at 12.5%. So 87.5% is considered to be the abatement, and on 18.5% I'll pay the tax of 18%.
Sure. While you at IDBI don't have plans which are health plans or insurance for car, etc., those plans don't have any savings component at all. So the incidence of tax will be on the whole component that I pay on the premium at 18%. Okay. What is it? While this percentage sounds all good, Kedar, what does it mean for the consumers or the policy holders from July 1? Am I going to see an increase in my premium cost once GST kicks in?
Yeah, so I will take it in two parts. So one, obviously, yes. So as a customer, when I was paying 15% as a tax, it is going to be 18%. Especially for life insurance, it is different because I have committed my premiums for next 15, 20, 25 years. And on that, I would have calculated my premium outgo that is going to go up by 3% of the premium. That is on one side. Having said that, insurance companies will get credit of certain taxes that they were not getting earlier.
Okay. Can you enumerate the taxes that you weren't getting a credit for today?
So like VAT we were not getting credit.
Sure.
CST we were not getting credit.
For your Krishi Kalyan cess, etc.
Yes, and yes, the Swachh Bharat cess that we were paying, it was not creditable. But all these taxes are now being subsumed.
Sure.
And so they'll be available for credit. Now we'll have to see how much does the cost go down for us, and we will be keen to pass it on to our customers to the extent maximum extent possible.
On the input side, what sort of services as a financial sort of sector do you have to take on which you will get credit now?
So we have insurance commission, which is a big piece. We have reinsurance premiums that we pay. We have sponsorship costs that we incur. All these are input services and all various services that we use to provide service to our end customers. They will all become input services on which we'll get credit.
Sure. You mentioned insurance commissions, Kedar. So you will have many and more insurance agents that
Yeah.
will be selling your products.
Yeah.
Now, it's not that each of those guys will have to get registered, right? It's you as an entity in different states which will get registered, and again, the tax will work on reverse charge basis there.
Yeah, so that's a very big thing for insurance sector. There are around 20 lakh or 2 million insurance agents, and them having to comply with the tax requirements individually would have been very onerous. But thanks to reverse charge mechanism, we as receiver of service, we pay the tax and get the credit of that as input service tax.
Sure. Will that
GST.
mean that the commissions will come down in any fashion or no?
No, commissions will
So
not
the
come
commissions
down.
will remain the same.
Yes.
You will just get credit for those services.
Yes.
All right. Okay. Kedar, also help me understand that you're now going to be moving to a very technology savvy tax system, and the network is called the GSTN.
Yes.
Technology wise, how much of a change is it for you as in the financial industry?
Payaswini, I must tell you, it's a sea of change, and thankfully, GST rollout has been on the cards for a while, and industry proactively, I can speak for life insurance through Life Insurance Council. We have been having multiple rounds of discussion in terms of how we can be prepared for this kind of rollout. But it's a huge change because the way we compute taxes, the way we levy taxes to the customers is we'll have to do system changes in many back-end systems. Number two, and the bigger change also is going to be in terms of return and reconciliation. So we'll have to file returns, and so will our vendors and our customers will have to file. The corporate customers will have to file their returns, and the whole input credit mechanism, the way it will work, it has to work very seamlessly, and that's a big change that we as an industry will face.
So there are very defined timelines for your GSTR forms, right?
Yeah, yes.
I mean,
Very,
again,
very tight timelines.
again, how will it sort of work for you?
So for us, we get a few days to file our return, and few more days for reconciliation with all our input credit suppliers in terms of correcting the mismatches, and everything has to be complete within 20 days from the end of the month. So that is quite stringent in terms of, if you look at the tech savvy companies, it is simpler, but you have vendors which are in all starters, and it's very important that everybody really comes up the curve to make
Have
sure.
your vendors come up to you and with any problems or challenges of sorts?
No, so we have proactively started connecting with them, asking them what they require in terms of help from us. We've been doing all that, and we are kind of, as far as we are concerned, I think we are fairly there, but there could be industries where their vendor base or their customer base is extremely large.
Sure, you already pointed out to me a challenge where, and that's not specific to financial services, it's across industry where you incur a certain cost, but you don't get the input credit for that in time. Specifically for the insurance industry, because your rates are regulated by the IRDA, what are the specific challenges that you could face? Do you expect that maybe your margins might squeeze?
So very, very valid point, Payaswini. We are what premiums we charge are regulated. They are decided upfront, and we cannot charge more, cannot charge less. So in this kind of scenario, if I'm not able to get my input credits because of my vendors, return challenges or reconciliation issues, then that will become a cost for me, and that will squeeze my margins. The other aspect to this is that even our expenses are regulated, so we are allowed to spend X, put to a particular level in terms of premium and our sum insured. So, and that could create a challenge, but I'm sure the industry will work together well on this, and I'm sure things will settle down very well. And you might have some teething troubles initially, but I'm sure I think it's a step in right direction by the government, and I look forward to seeing a much more connected, governed, well-governed economy in this fashion.
Sure. I just want to have one last question, Kedar, on the pricing, which you said that invariably the price for the end customer will go up, the cost for the premium will go up. Do you anticipate any sort of demand dip because of increased cost on any particular kind of product that may have, like for instance, I don't think in India customers or many consumers are still very up to speed or understand the value of a term plan, right? Because you don't see any savings or any returns come out of it, at least in your lifetime.
Correct.
And on that product, now if there is an 18% tax, do you see the demand for that in any way vary?
Yeah, so really speaking, we were looking at, to go back to your earlier question, we were looking at lower rate to improve the penetration and to improve the reach of the term insurance as a product where, people get cover where large Indian population is still not covered thanks to PMJJBY. The reach has improved, but we were looking at that. But yeah, I guess in the short run, it might affect the decisions of the buyers. But I guess in the long run, once the tax system gets settled down, my take is that since it is going to broaden the tax base, overall tax rates have the possibility of coming down or settling down very well.
All right, here's hoping to that, and here's hoping that the customers continue to see the value in the product, insurance products. Kedar, thank you for joining us with your perspective, and thank you so much for watching.